Welcome to All Things Real Estate. I'm Bethany Angel, your favorite South Carolina realtor. And you know, the questions that first-time home buyers ask in South Carolina are the same questions they're asking everywhere. Can I really afford this? How much money do I really need to save? And what if my credit isn't perfect? And you know, they're frustrated. They're getting advice from people who maybe bought their home 15 years ago. To help us, I did what I always do. I brought in an expert. And with me today is Adam Brooks. He does this every day, and he's here to give us the answers to the questions that you have. Welcome to the podcast, Adam. Adam, can you tell us a little bit about yourself and what you do?
Sure, yeah. So I've been a mortgage lender now for the past 6 years. Before that, I was in financial reporting. So I like the analytical side of things, structuring loans and helping out clients that way. That's kind of how they mix. I was doing more back office stuff, but I wanted to be in front of clients. So mortgage lending has been a really nice mixture of the two.
You know, when we first met, I called you because we were working with a buyer. I was working with a seller, and you were representing a buyer, and their budget was really tight.
Yeah.
And you spent a lot of time with me, giving me the insights I need so that we could structure a deal that worked on both sides.
Yeah.
That's when I knew that you were somebody that really cared about people, that you cared about getting them into the house, that you didn't just want to process a mortgage for them.
Yeah, well, thank you, Bethany. I appreciate you saying that. And I really appreciate you as a listing agent actually reaching out about that deal. Those clients had placed a couple of offers before and they had fallen through. And I think the reason why they were FHA clients and they needed down payment assistance and their budget was tight. So a lot of times I think there's 2 transactions before yours. They placed in an offer that was lower than ask, and they had just been dismissed out of hand. So when you called me to ask if there's any way we could structure this that would work for your sellers, because I believe they had a couple of contracts fall through as well. And so finding something that worked for both of them, I think they ended up giving some concessions and getting a little bit of a higher purchase price, and it worked for both parties. So I appreciate you asking, hey, what can we do to make this work, instead of saying, oh, this is FHA, oh, this is DPA, this is probably not going to be a good deal, and just moving on.
That is so true. You know, having the right loan officer on your side makes all the difference in the world. I was so surprised that you were open and took my call and talked through the situation with me, because I have had this situation where the lenders wouldn't talk to me, and it's very important. It was what got us through the finish line.
Yeah. You know, it's funny. I think, you know, being a lender, I often ask realtors what's most important to them. What do they look for in a lender? And the answer is kind of simple. And you think, okay, well, everybody should be doing that. And it's true, everyone should, but not everybody does. And one of those is good communication and being available to walk through things like that. Because there's often spots in the transaction where there'll be some friction. You know, maybe the appraiser comes back low, maybe the offer is below the asking price, maybe the buyer needs some concessions from the seller. And those issues can be worked through in a way that works for both parties, but you have to talk about it to find out. So that's a requirement for a lender or for a realtor. Are you willing to have these discussions and negotiate a little bit to create a structure that works for everyone?
Negotiation is key, but also having that depth of knowledge is very important. I find that sometimes when buyers are working with a lender, the lender's pushing just one type of loan when we know that there's many out there. And we'll go over that in a minute. But how about we start from the beginning? What is the definition of a mortgage? What is a mortgage?
Oh, great question. Just put simply, a mortgage is a loan for a home. So like you said, if you don't have cash, then you're probably going to need to finance it in some way, and a mortgage is the way you do that on a home.
That's right. Most people don't have cash to go buy a home, so they need a lender and they need a mortgage. So let's say that I'm working with a couple. They're very excited. They are going to buy their first home. They're ready to go see homes, and I need them to get pre-approved. I need to see how much they can afford. They don't even know how much they can afford. Right. So they call you. What does that first conversation sound like?
That's a great question. The first conversation with the buyer is really getting to know them, their goals, and then after we've gotten to know each other a little bit, I'll ask them some more of the details about their income, their employment history, their credit, how much they already have saved up, what kind of timeline they're looking to move on. All those things factor into the structure of the loan and the type of loan product that I would recommend.
So you're trying to assess what kind of loan might be good for them so that you can guide them. Do you sometimes start down one loan path and then move to a different loan?
Oh yeah, all the time. Sometimes, just recently, I was talking to someone and they were a veteran, they introduced their partner as their wife, and so I started down the VA loan program because it's zero down, has a great interest rate, doesn't have mortgage insurance. I think he had been injured, so he didn't even have a VA funding fee. So it looked like it was going to be a perfect fit for them. We got further down the process, and I noticed their last names didn't match up. And so I just asked, "Are you guys married, or are you partners?" And he said, "No, this is my girlfriend. We're not actually married." And for most loan products, that doesn't matter. But for a VA, you actually do need to be married to your spouse in order to qualify for that loan program. So we had to completely scratch that. We ended up going a conventional route. We switched the order of the borrowers. She had more income and a higher credit score than he did.
Wow.
We made her the primary. So it completely changed the transaction. Still was able to pre-approve them, but it was not at all what I thought just based on our initial conversation.
So you still got them a good loan. It was just looked different than what you started off with.
Exactly.
That's awesome.
Yeah.
So let's go back to that first conversation when you're trying to find out about how much money they make, what all kind of debts they incur.
Right.
So what all goes into what's called a debt to income ratio, and what is that? You guys, loan officers, throw out that word all the time.
Yeah.
And there's things that I think people don't even realize is in there.
Yep. That's a really great question, because the debt to income ratio is probably what keeps most of my potential clients from buying a home. It's probably the single biggest issue. What it is the ratio of your debt to your income. So, and we do it on a monthly basis. So if you make, we'll use round numbers, but let's say you make $100,000 a year, your income is roughly $8,000. Most programs, they want you to stay below 45%. Some can stretch to 50, some even 55, but we'll say 50. That would mean that your monthly debts would need to be less than $4,000 in order to have a debt-to-income ratio under 50%. And things that would be included in your debt-to-income ratio would be like car payments. If you have another house, obviously your mortgage payment, student loans, that's a big one, credit cards. There's some things that some people think are in there that aren't. Your cell phone bill is not on there because that's discretionary. You don't have to have a cell phone. It seems like you would, but that doesn't have any utilities that you pay. Those aren't part of your debt-to-income ratio. But anything that you have fixed monthly payment on, shows up on your credit report, that's going to be part of your debt-to-income. Something that is included in your debt-to-income that a lot of people don't realize because they aren't making payments is their student loans. So student loans, even if you're in deferment, we have to calculate them as part of your monthly expenses at a rate of 0.5% of the total loan amount. And that can add up. I was just speaking with someone recently, and they said, hey, they had calculated their debt-to-income ratio, and they thought they were about 35%. And I said, well, I'm calculating 68%, and I showed her a list of her liabilities, and she's, I didn't realize that you were counting my student loans because I'm not making payments on it. So in her case, it made a huge difference. And again, we needed to look at switching loan programs before we could move forward. But that's a big part of DTI that people don't realize.
Something that I find that young buyers come across is they don't realize that car payment, how much that affects. They want the expensive car, but then it comes to buying a home, and that can really affect their debt-to-income ratio. Do you find that to be the case?
That's a huge issue, and I joke, not to the client, but I kind of make jokes. There's a joke among lenders and realtors, like, I hope that you want to live in that car, because a lot of times they might have $1,000 or $1,200 a month payment on their car.
Wow.
And it's like, wow, well, unfortunately, that's keeping you from buying a house. So obviously, if you have the car payment already, there's not much can be done about that. But if you're looking to get pre-approved or you're looking to buy a house, it's really smart not to buy a vehicle while you're in that process. If you need to, for whatever reason, just talk to your lender first, because sometimes, depending on your situation, you have room to do that. Sometimes it'd be okay if you bought it with cash, but wouldn't be okay if you finance. Other times it'd be okay if you finance it, but not if you bought it with cash, because you need that money for closing, and your debt to income ratio is fine. Other times, you've got the cash position is fine, but the debt to income's not okay. So all of those things weigh in, and anything can really be avoided as long as you're willing to have a conversation before you pull the trigger on any major financial decisions like that.
That's a good point. Sometimes on our credit statements, like on the portal of our credit card, it gives us a credit score.
Yeah.
Can you talk about that? Is that my credit score?
So most credit card companies and then some third-party companies like Credit Karma will produce an estimate of what your credit score is. And those can be reliable, especially for some types of purchases. Like if you go to buy a car and you've got an Experian account, say, and it shows you your Experian rating. Well, that number might be accurate for a car credit pool. But when you do a mortgage credit pool, it's a different model, a different scoring system, and it weights things differently. So I find on average, most clients, their credit score is 40 to 50 points lower on a mortgage report than it would be on one of those third-party apps like Credit Karma.
That's a big difference.
Yeah, it's huge, and it can affect qualification. So I usually ask people roughly what their credit score is, but I tell them that we really need to do a mortgage pool before we can know for sure what they can be qualified for.
That's so true. Okay, so let's talk about, you mentioned the VA loan earlier.
Yes.
And you can go over that again a little bit, but tell us about the typical loans that you share with your buyers.
Okay, so I would say there's probably 4 primary loans, and then there's a multitude of more niche loans. But the primary ones are conventional loans, FHA loans, USDA loans, and VA loans. That most people fall into one of those categories. If you're self-employed or a small business owner, then there's many others to look at, such as DSCR, which is debt service coverage ratio. If you're looking to buy an investment property, you're more concerned with the performance of the property's rent than you are with the person's ability to repay it, because they're going to have a tenant in place that's going to be paying that.
Okay.
If you are a foreign national, or maybe you've got a tax ID number but you don't have a social security number, we can do
called like an I-10?
I-10, yes. Individual tax identification number. Maybe that's it. But anyways, yeah, those can help. A lot of times we have people who have a work visa, and they can buy homes. A lot of times people think, I've got to be a U.S. citizen to buy a home in the United States. That's not true. There's some programs that you'll be excluded from, but if you're a permanent resident, especially, you have access to almost anything. If you're a non-permanent resident, that does limit your options somewhat, but there are often workarounds. They just typically have to have a higher down payment or have a certain type of visa.
That's awesome.
Yeah.
So let's talk about for first-time home buyers. What are the typical types of loans that they're looking at?
So for most of my first-time home buyers, they're typically looking at, right now I'm seeing a lot of down payment assistance. About a third of my business is with down payment assistance. South Carolina Housing is a state program that has fully forgivable loan. They're considered a loan, but they're fully forgivable. It's a 15-year fixed note that goes alongside your primary mortgage with 0% interest, 0 payments. If you sell the house within 15 years, that has to be repaid in full. Otherwise, that money is all yours. It does have limits on your income, which varies by number of people in your household and county, and it also has a income limit, or a house price limit. So if someone doesn't fit into that category, and it's also a little bit more strict on DTI. If someone doesn't fit into that,
debt to income ratio.
Okay. Yes. So if someone doesn't fit into those parameters, we also have another DPA program that is not limited to first-time home buyers. It's much more lenient on their debt-to-income ratio. It allows for lower credit scores, and it doesn't have a house price limit. But that one does have to be repaid over 10 years. So typically, if you can qualify for both, I'd go for the state housing. But if you can't, what we call in our in-house at Movement is Boost. If you can't qualify for the state housing, Boost is a great backup option. Like I said, it's much more flexible. So there's lots of scenarios that it can handle that the South Carolina state won't touch.
So your company literally wants to boost people into their home.
Yes.
Tell me about this Boost program.
Okay, so for regular traditional stick-built houses, credit scores are acceptable down to 600. If you want a mobile home, it's at 640. So it's a little bit more stringent on those. They have to be double wide mobile homes. Your debt to income, we can stretch all the way up to 55% of your gross income. So that's a lot more lenient. You don't have to be a first-time home buyer, like I said, and there's no income limit. So that really opens the door to just about anyone. I'm trying to think of anyone that wouldn't be qualified for that. I guess if they were below that credit limit, but for the most part, that's a great way. I've had people in Charleston buying, $400,000 or $500,000 houses, which up here would be, pretty expensive. Down there, not,
Yeah.
and they're first-time home buyers and getting 5% in assistance. So on 400,000, that's what, $20,000, in assistance.
That's awesome.
And that really helps because most people don't have that. Even if they're buying at that level, they don't have that much cash. So it can be really helpful, and they're willing to, make a small extra payment to repay that DPA.
So we talked about VA loans. We talked about some conventional loans. There's people out there. What about, are there any loans like for first responders or teachers? Is there something special for them?
Yeah, there's something through South Carolina State Housing Department. They usually do it once a year. The funds are limited. It's actually coming up. Usually they release the program in March or April, and typically the funds are going within a month. But instead of their typical $10,000 down payment assistance, or DPA, I don't know if I defined
What's
that earlier.
What's DPA again?
Yeah, down payment assistance.
Okay, down payment assistance.
Their usual DPA is $10,000, and that's open year-round. During March and April, they will typically bump it up. Most recently, they bumped it up to $12,000 for that period for first responders, and they had a lower interest rate. I want to say it was like 4.875. It was incredible. So you got free money, and it was a lower interest rate, but you had to be either a medical professional, a first responder, or a teacher.
Oh, so for doctors. Or
Yes.
is there a different program specifically for doctors?
We do have a specific program for doctors called a physician loan or a medical loan. And the neat thing about that program is it doesn't have PMI, even if you're putting down less than 20%.
What's PMI?
I knew you were going to ask that. It's private mortgage insurance.
Okay, we'll talk about that a little later.
Okay, we'll talk about it later. Okay. So the doctor's loan, you can avoid PMI even though you're putting down less than that, less than 20%. So that can be really helpful, especially because the income progression for a resident doctor, it stays low for a long time, and then it really elevates. And basically, we're betting on the fact that those are going to be able to repay their loan later in their career, and so we're willing to give them more generous terms up front.
Awesome. Okay. Something we haven't talked about is closing costs. We've been talking about down payment assistance, but first-time buyers don't think about closing costs.
Yep.
They might not even know there is such a thing as closing costs.
Yeah.
They just focus on saving that money for that down payment. So
Right.
what are closing costs? What are the typical closing costs?
Okay, that's a great question. Yeah, whenever you're buying a home, you need to consider your down payment, which is a percentage of the purchase price, and your closing costs. Now, a lot of times people will say something general like closing costs you expect to pay somewhere between 2 and 5% of the loan amount. And while in a general sense that's true, it doesn't hold true on the extremes. And what I mean by that is if you're buying $1 million house, it's not going to be 5% of $1 million. And if you're buying a $100,000 house, it's probably going to be more than 5%. The things that change are your taxes, your insurance escrows, and if you do have PMI, that's going to be very based on your credit score. Insurance is going to be based on what carrier you use, and taxes are going to be based on what county you're in. Those are the big things that change. Most other costs, your appraisal, your lender fees, your title fee, your attorney fee, they're going to be roughly the same. So I tell people, instead of looking at it as a percentage, assume that you're going to need about somewhere between $8,000 and $12,000 in closing costs. So $10,000 is a nice round number. That's usually what I tell people to estimate for. Now, again, with DPA programs, you're not going to have to come up with all of that yourself. I don't know if you have questions about seller concession.
So down payment assistance programs can also cover some of the closing costs?
Yes. If you have, let's say that you have a FHA loan, your closing costs or your down payment is going to be 3.5%, but your closing costs, let me try to say that again. If you've got a situation where the down payment assistance covers your down payment and there's some left over, that leftover amount can be applied towards those closing costs.
Oh, okay. That's awesome. Does anybody apply for an FHA? What is an FHA?
An FHA loan is more flexible than a conventional loan. So FHA is typically geared towards first-time home buyers. It has more flexible DTI requirements. It has more flexible credit requirements, and it often has cheaper MI or PMI, private mortgage
Okay,
insurance.
so now that we keep bringing that up,
Yeah.
let's talk about private mortgage insurance. And there's other terms, right? Depending on
Yes.
the type of loan.
Yeah.
Can you tell us about those? Because
Sure.
that's an additional expense that you're thinking, oh, okay, well, I'm buying a home for this amount. This is my interest rate. And you try to calculate it yourself, and you have this idea in your mind that this is what it's going to cost me. And then all of a sudden, you didn't account for this private mortgage insurance.
Yeah. So private mortgage insurance is what allows someone to buy a home even if they aren't putting down 20%. So a couple of decades ago, you had to put down 20%. That was it. You either had, a fifth of the price of the house or you didn't. And if you didn't, you couldn't get a loan. Now, the financial industry has devised a way to insure themselves against people who have less skin in the game. So maybe you're only putting down 3.5%, maybe you're only putting down 5%. You're paying an insurance company to ensure you not defaulting on that loan, and that makes investors a lot more comfortable. They say, okay, well, if for whatever reason this buyer defaults on their payments, this insurance company will make me whole. Suddenly, that opens up a lot more buyers into the home buying realm, if you will. So it's a very helpful tool. But yeah, you're not going to be able to calculate it yourself, most likely, because it's going to vary based on your credit score. And again, if you're using a third-party app to calculate your credit score, you're not going to know what that is either. And it's not just the credit score. There's lots of what they call layered risk. They want to look at what's the loan to value of the house, so how much money you're putting down, how much money do you have in reserves? So reserves are money that you have in your bank account that you aren't using for the transaction. The more reserves you have, the more stable of a client you are, right? It shows, hey, this person is saving up. They can take care of something. If something bad happens, they're not going to skip their mortgage payment. If their car breaks down, they have the money to fix it and not skip something else that's important like that.
That's good. So PMI might be called something else depending on the loan.
Yes.
Okay.
Yeah, but it's all basically the same thing.
And are they all, how do they get calculated? Is it like every month on your loan? So you pay your interest rate payment. What does our payment look like?
That's a great question. Yeah. So typically, if you just type in like a mortgage calculator, it's going to show you the loan amount, the interest rate, and then it's going to calculate principal and interest. But most people, when they're paying for a mortgage, they will also escrow for their taxes and insurance and PMI. So you've got 3 more expenses that you need to add to that payment to get your full monthly housing payment. You can calculate those things. Typically, PMI on FHA is calculated as 0.55% of the loan amount. But otherwise, you just need to ask your lender, hey, how much is this going to be?
So if I'm buying a $200,000 home, in South Carolina, it's okay. So let's say we're buying a $200,000 home. What a typical PMI look like?
You want me to calculate that in my head? I can't do that.
Okay. It's just what my point is, it could be a few $100s on top of your
Yes, it could.
payment
Yeah.
every month.
Yeah, I would say typical is probably between $100 and $150 per month.
Okay. Now, you mentioned escrow.
Okay.
Not everybody understands what escrow is.
Yes.
And so it's basically a special account, right, that lenders hold to put money in there to cover expenses for taxes and insurance. Tell us about what that looks like when you're going to close a loan. Like,
Okay.
you might think, oh, well, I only need to pay 1 month of
Right.
my taxes or 1 month of what, but what in reality do
Yeah.
we need to save and be ready for it to close?
Oh, that's a great question. Yeah, that's something that often gets missed. So escrows are funds set aside to pay for something. So your mortgage company wants to make sure that you're paying your taxes and insurance. They don't want to end up owning a home that's behind on taxes or that's uninsured. So what they do is add a specific amount to your mortgage payment, like we talked about, in order to, it's going to be 1/12 of what the total annual amount is for your taxes and insurance. So at the end of the year, you're going to get a tax bill from your county, but you don't actually owe it. It's going to be dispersed by your lender. You've already been paying it all throughout the year.
Okay.
But at closing, you have to remember that insurance is paid in advance. So you pay on your closing date for the following 12 months of insurance.
Oh, wow.
So that'll be a one-time expense, and then each month after that, you're paying 1/12 of your annual expense. So that way it'll be paid out automatically in the following year. Taxes are the exact opposite. You pay taxes in arrears. At the end of 2025, you pay for all of 2025's taxes. So you'll probably only pay 1 or 2 months at closing, depending on what time of year you close, and then it'll be 1/12 again until that following year, and then your lender will make that payout for you. So when you get that tax bill, it usually says, if you read it closely, this is not a bill. It's just telling you, hey, this is how much is owed. Your lender's going to take care of it.
What if I bought the home in October? Do I have to pay all the year's taxes for that, or how does that work?
That's another great question. Typically, everything in real estate is negotiable, as you know, but typically the seller will pay a prorated portion of the taxes. So if the seller's on that house for three-fourths of the year, they're going to pay 3/4 of that year's taxes.
Okay.
You're just going to pay those last 3 months.
So I won't have such a big tax bill.
No. Yeah, that's one of the advantages of buying later at the end of the year.
That's
Your
true.
closing costs are going to be lower because you're not going to be paying as much in taxes.
That's true. Okay, so back to my story. We have a couple. They're excited about getting married and buying their first home together. Now, their family wants to help them out,
Okay.
and they want to give them money for their
Okay.
down payment.
Right.
Can they do that?
They can. Yeah, you just have to trace all of the funds. But we always talk about having a paper trail. We have to know where these funds come from. And the reason why lenders are concerned with that is they don't want you to go down the street to a payday lender and borrow money and then use that as a down payment. At that point, you don't really have skin in the game. You now just created 2 loans instead of 1. That doesn't make us feel warm and fuzzy as a lender. So if you have your parents or other relative who wants to gift you funds, they have to sign a statement that says, hey, this is truly a gift. We don't expect repayment. This is to help this person buy this house. If we have that paper trail, we're good to go. If your relative won't sign that, then that's a problem. If they gave you the gift and it's been a couple of months ago already, then we may not need that letter at all. If it's been sitting in your account for over 2 months, we're only required to look back 60 days. So in that case, you wouldn't need any documentation. But most of the time, people aren't willing to give you the gift until you're actually closing.
Yeah, I see that. So say that you're working with a couple. They're in the process already. They've already filled out their paperwork. They've already been pre-approved. We're getting ready to make an offer, and they're getting really excited about their house that they're in the process of buying. They
Okay.
made the offer. The offer's been accepted. What are things that they need to be doing with you as a lender?
Well, just keeping me updated the process. One time I had a deal where I didn't get the contract until a week after they had already made the offer. So that put us in a bit of a crunch.
Hey, that was on the realtor. The realtor needs to get that to you right
Yes,
away.
and but yeah, I don't. that is very helpful, and the lender should be asking for it. So you definitely need to do that. Then you're going to want to be in communication with your lender if you're doing anything that's going to change your financial situation. So if you're changing jobs, again, don't advise that. But if you have to for whatever reason, just let us know. I have had someone lose their job in the middle of transaction.
Oh, wow.
Fortunately, they were able to get another job, and it postponed closing, but it didn't blow up the deal. But again, it was important that they told me because we call their work to verify their employment, and they said, yeah, they don't work here anymore. That's a problem,
Yes.
So just keeping your lender in the loop with everything that's going on in your life is really, at least financially speaking, is really important to do. And also, staying in touch with your realtor. Your realtor is probably going to have some advice and some recommendations for you as far as inspections and negotiating the contract and all that. So, if your inspections are required, definitely let us know about that. If they're going to be repaired, we need proof of that. Same thing with the appraisal. Obviously, that'll be emailed to us directly. If there's anything that we notice that needs to be fixed, we'll let you guys know. And then once the seller fixes it, we need to have, documentation that's been corrected.
So what are things they shouldn't do for sure?
For sure, shouldn't do. Try not to change jobs. Try not to buy anything expensive. Don't open any new credit cards. Those are the big 3.
There's so much to learn about this. There really is a lot to this. Adam, thank you so much for coming today and sharing with us your wisdom. I'm Bethany Angel, your South Carolina favorite realtor.